Good morning, everybody. Turn on your cameras. Turn on your cameras. Trish, good to see you. Made it back from Montana. Safe drive. Hey there. Shelly,
Good
good
morning.
morning. How are
Good
you?
morning.
Turn on the cameras, guys. It's great to see everybody. Participate with us. If you're in the shower, leave them off. If you're not, turn them on. Yeah, whatever. If you're driving, be safe. But come in here. I know you're doing other things and multitasking and all that stuff. It's okay. Want you to try and focus. Eddie, good morning. How are you?
Hey, good morning. Doing
Where
well.
where are
How
you
about
at,
you?
Eddie? Where are you from?
Jackson, Mississippi.
Jackson, Mississippi. There you go. Kingsley, good morning, sir. Where are
Good
you
morning.
from? Where are you
New
at?
York.
New York. There you go. There's Joe up in Montana, Kristen in Montana. It was good seeing them. Kathy, how are you?
Morning. Sorry, I'm a minute late.
Oh, you're good. You're good. So there's Brian in his closet back there. Hey, Brian. Brian's here in Colorado Springs. So anyway, guys, let's go ahead and get started. Appreciate you being here. We've got people on here from obviously all over the country, and we open this up. We do this every Tuesday. So if you've never been on here before, welcome. We do it every week. We've done this now for about a year. Every Tuesday morning, 11 a.m. Eastern, 8 a.m. Pacific time. Just stuff to help with transactions. The last couple of months has really been awesome, especially with the shift going on. Lots of different things we've been talking about. Lots of great ideas on here. I've been doing this now 20 years. My wife and I work together in Colorado Springs. Been very successful out here with this. Been in the top 20 in town and all kinds of stuff here. But just love giving back however we can. Been part of EXP now for coming up on 5 years. This has been good. I'm learning things every week. I got my notepad out, and every week I get off here, and my wife and I are sharing ideas that we picked up on this thing. So it's been really, really good. Quick announcement about next week. Okay, it's going to be a little bit different next week. We will not be here at 9 o'clock. Or 9 o'clock Mountain Time. We'll actually be here at 8:30, 10:30 Eastern. Okay, 7:30 Pacific, which I know is early, but Kelly Fasterling, she's here in Colorado Springs. She's a realtor here, and also a financial planner by background. She's trained on here a few times. We're going to be she's hosting a wealth summit. So this will be the fourth one of these that she's done. So she's going to have a wealth summit. We're going to be live here in Colorado Springs at a Hyatt hotel. We'll probably have 30, 40 people coming in for that live there directly, but we're also going to stream it live in the, Freedom team. So again, open to everybody. Okay. That will go from 8:30 to 11:30 Mountain Time. You can come and go as you want. You can come for one session of it and leave. You can be there for the whole thing. It's going to be awesome. 6 different speakers. I'm going to speak. Kelly's going to speak. We have several other agents coming in, talking, whatever, all kinds of stuff on just investing, on just, on the market right now, on just ideas that to share about the shift, all kinds of things. It'll be a powerful 3 hours. Afterwards, we will be going right into a presentation for EXP. So if you're not part of EXP, you could stick around for that if you want to learn about this model. If you're part of EXP, you could invite people to come into that just to see what we're doing here, but they're always welcome, obviously, with what we're doing. But next week, it'll be a different thing. It'll actually go for about 4 hours total. So you can come and go as you want. You can, register for it. We will get the links and everything out to register for that, so you have all the details. I'll start putting that into the workplace group in Freedom Team today. Okay, so let's get started with what we're doing. Obviously, lots going on with this market. We're seeing just major slowdowns and things. We're seeing buyers pull out because of the interest rates. We're seeing sellers, not list. The listings are dropping as well. But there's still ways to make this work. Some big ways. One of the things I remember, we haven't had to do this for a long time. Buydowns. Some of you guys have been around a while, you know what buydowns are. Some of you have no clue what buydowns are. I mean, I don't know, 3 years ago, an appraisal gap. What the heck is that? We've all had to learn new terminology, in all these different shifts in the market. A buydown. There's all kinds of ways to do it where you can actually help your sellers market their home without doing major price drops. And actually, the buyers don't care about the price of the home as much as they care about the monthly payment. And there's ways to help them with that and buy down that interest rate, get it lower, help the sellers to participate in that, get it sold without having to do a $20,000 price drop, which might not mean anything for the buyers. Okay. They won't even look at the home because again, they're pulling back thinking they can't buy. There's just ways to do it. So some of us who've been around a while will share some different things with this. But I've got Jim Sherman on here, and let me see here. Jim, let me just see if John's not on here yet. I'll watch for him, or if you see him on here, let me know. But Jim's camera isn't working for whatever reason. We were trying to figure that out, technology, whatever. But Jim is an EXP agent. Okay, been in the business a long time, but he also does a ton of stuff with financing, working with Benton Capital, who is here in town. They sponsor all of our lunches that we do here for EXP. Great lenders, but they're also licensed, almost across the entire country with some of the things they're doing. But Jim can share what's going on here as far as Buydowns, and we'll start going into this process here. So, Jim, why don't you go ahead and just introduce yourself a little bit, and you can share your screen here. Yeah, if you want to share anything about you, and then let's dive into this. But I appreciate you doing this, Jim, putting this all together for us. So, thank you.
Well, good morning, everybody. I appreciate you all being on this call, and I've been in the mortgage lending since about 1991. So I've been through what's going on now, probably 3 or 4 different times. And I wound up getting out of the business in 2008 when the market crashed. And then I got back in about 2.5 years ago, and a few things had changed in the mortgage business, but I got up to speed. And so the buy down section to me has been something that's real important right now, because it is different trying to get people pre-approved. And a lot of you probably have a lot of your clients on the sidelines now waiting for rates to go down. And there's some options here on the buy down side so that you can kind of rejuvenate those borrowers and get them back in the game. And I'm gonna show you some different options on the buy downs. So what is a buy down mortgage and how does it work? First of all, in short, a buy down mortgage is a home loan that features a reduced rate for a temporary period of time. And what I'm going to do is open this up to questions as we go, because some of you are going to be very much aware of these buy downs. Some of you have never seen buy downs before, because the market has been so good for the last 13 years. So it's a temporary period of time, whether it's 1, 2, or 3 years. The interest rate may be reduced 2% lower in the year 1, 1% in year 2, and then it goes back to the note rate the year after that. An upfront cost covers the lower monthly payments with the required funds set aside in a buy down account. Each month during the temporary buy down period, the borrower makes a reduced monthly payment with an additional amount released from the buy down account to cover the difference. So what I'm going to try to do is to get into a little bit of detail, but not get deep into the weeds so it doesn't make sense. I don't want to get into a lot of detail. I wouldn't mind doing that one-on-one with any one of you that want to contact me. I can get into as deep into the weeds as you want. But typically borrowers opt for these buy downs because they expect their income to increase in the near future. Or another option is we figure that rates are going to go down at some point, which I feel they are. Sellers' concessions can be used towards these temporary buy down mortgages. There's also something called a 1-0 temporary buy down. And what this is you're simply buying down the interest rate 1% the first year. The general buy down rules are as the annual increase in a mortgage rate is capped to 1% to avoid payment shock. And I don't know if all of you are aware what on the mortgage side, we have to be cognizant that the payment that they're used to paying on their mortgage that they have existing, or the rent that they're paying, there's a relationship between how much that payment can be raised before we run into a payment shock situation. So borrowers with these temporary buy downs, borrowers still need to qualify at the full note rate, which is the end rate on a 2-1 buy down at the end of the third year, or on a 1-0 buy down at the end of the first year. Buy downs are only permitted on certain property types, such as primary residence and second homes, with investment properties prohibited. Now, that's typically in most cases. There are some lenders out there that will allow buy downs on investment properties, but it's a very limited number of lenders that will allow that. Buy downs can be used in conjunction with FHA loans, VA loans, and conforming loans backed by Fannie Mae and Freddie Mac. Buy down funds are not refundable unless the mortgage has been paid off ahead of time. Does that make sense to everybody?
Any questions so far? We're just getting into the beginning of this. Any questions at all right now? Some of you are brand new, I know, in the last couple of years, and this is, again, it's just new stuff. Any questions for any of you right now, just so far with what he's gone into? Anything? Okay.
So what we've gone into so far are temporary buy downs. So that means the client's rate is going to be changed every year at the anniversary of their mortgage. So what we're going to go into right now is permanent rate buy downs. The permanent rate use a permanent rate buy down to reduce your interest rate. Your interest rate will remain at the lower rate for the life of the loan. You can do a buy down by purchasing discount points on your loan at closing. Discount points typically cost about 1% of the mortgage loan amount and reduces your interest rate approximately 1/4%. Now, this is typically, it's changes periodically. So each and every day rates change, and sometimes they change 2 or 3 times during the day. On a permanent rate buy down, the borrower will qualify at the bought down rate. Any questions on that part of it?
Go back to that slide, Jim. Just hit your back arrow. Go back, just so we go back. If you can, hit the back. Just hit the back arrow on your keyboard, the backspace.
Okay, sorry.
I don't want to mess you up here. Yeah, I'm sorry.
That's okay.
Click on that. Hit the backspace. One
Okay.
more time. There you go. So any questions off of this right here? How much? So okay. So all right. One discount points typically cost 1% of the
They're
mortgage
of the
loan
loan
amount.
amount. They're not of the purchase price. They're the loan amount.
Okay.
And typically one discount point will reduce your interest rate 1/4 point.
Okay. Got it.
And one of the big things here is on a permanent rate buy down, the borrower will qualify at whatever rate you buy them down to, which is a big deal in this market right now.
Mm-hmm. What were the rates as of what were they yesterday? I know last week they got up into the 7s. Are they still in the 7s right now?
Yes, yes.
Okay.
They're approximately 7 3/8 to 7.5.
Okay.
Depending on the lender, depending on the day, the time of day.
Yeah. Yeah.
Any questions on this?
Will we have these slides as notes? Will you be able to share those as notes later when we're finished?
Yes.
Okay, thank you.
Yeah. and
Anybody
I can-
that would like
yeah.
to have these, if they can just go into the chat and put your email address in there.
Jim,
And
if you want, you could share this file with me through Google
Okay.
Drive, and then I could post it up to the workplace group,
Okay.
in
All right.
Freedom Team as a file, so that way everybody now. And if you're not part of EXP, let me know. You could message me, put it in the chat here. We'll make sure that that we get these out to you for sure. Craig, you have a question? Let me see if you're. Can we hear you? Can't hear you. I'll look in the
Unmute
chat.
yourself.
Go ahead. Yeah, he's unmuted. It's just not working. Go ahead and type your question in the chat, Craig, and we'll get it answered. Okay. Very cool. So, go ahead, Jim.
Okay.
can I throw
ahead.
something in right here?
Yeah, go ahead,
So
Kev.
I was kind of just doing a little quick math. Just, for me, this has helped me over the years. Just to put it kind of in I guess practical terms of how this would help and how you can communicate to your customer, or at least for you to maybe wrap your head around it as agent. So I kind of just did a little quick math. Like, so if somebody had a $350,000 loan amount, by buying the rate down, he just said that it was about a quarter of a point that 1% pays. So 1% is $3,500, right? For buying that rate down a quarter of a percent. And on a $350,000 loan, that would make about $60 a month difference in a payment, approximately. Versus if I have a seller and I'm going to reduce the price of the house, maybe as an incentive, you offer to do a buy down because now it's going to reduce the buyer's payment by $60 versus if you just pay $3,500 if you reduce the price by $3,500, you're going to save them $10 a month. So it makes a big difference, and buyers are payment sensitive more than they are price sensitive. And so it just makes a big difference when you have the knowledge of some strategic kind of financing, like we're talking about today, in communicating with your client.
Does that make sense to everybody, what she just said there? Because we got a lot of sellers right now. They just, whatever. They're either pulling back or they don't want to list, whatever. They don't think they're going to get what they want to get and whatever. And, Elaine and I, we have a home listed right now. It's up in the sixes. And that's what we started doing. Rather than drop the price by 20, 30,000, let's do this and market that big time. We will buy down the rate, whatever. We've got funds in there that we can do. We'll help with that.
So you're going to help them a lot more on their payment, again, than if you just reduce the price 10 grand versus paying 10 grand to go buy the rate down, whether it be through, a 2-1 buy down, or whether you just buy the rate down on a permanent 30-year fixed or whatever. It's going to almost always, if not always, it's going to make a much bigger difference than your buyer's or a buyer's payment.
Exactly. Craig, I think I heard you there. Is your mic working now?
You can hear me now?
Yeah, we can. Go ahead.
Okay, so my question was just on a straight up buy down. Can the seller use that? Can you use the seller concessions to buy the rate down, or only on a 2-1?
No, they can do it on any of the buy downs. Each program, whether it's FHA, whether it's VA, whether it's conventional, has a different amount that is allowed as a maximum seller concession. And if you guys want to write this down, first off, on an FHA loan, it's 6%, up to 6% of the purchase price in a seller concession. If it's a VA loan, it's 4%. If it's a conventional loan and they're putting 5% down, it's a maximum of 3%. If they're putting 10% down on a conventional loan, it's 6%.
Wow. Okay. So if the
Can you
buyers are
repeat
putting
that?
down,
I'm so sorry.
if the buyers are putting down 10%, the sellers can give a 6%, up to 6% of a concession.
On a conventional
A
conforming
conventional
loan.
loan. Gotcha.
Would you mind repeating those
No, absolutely. So
criteria again? I'm so sorry.
no worries. On an FHA loan, it's 6% of the purchase price is the maximum seller concession. On a VA loan, it's a maximum of 4%. On a conventional or conforming loan, if the borrower is putting 5% down, it's a maximum of 3%. If the borrower is putting 10% down, it's a maximum of 6%.
It's good. There you go, guys. If you need that in the chat, I think Kim just put that in the chat. Thank you, Kim.
Thank you.
Cool. So go ahead, Jim. Let's keep going
Okay.
through this here.
All right. Now I'm going to get into some other strategies that can be used other than a buy down, and then I'm going to get into an advanced strategy with a buy down. So adjustable rate mortgages is something that hasn't been very popular for the last 13 years because the fixed rates were such a low point. So one of the things that happens with an adjustable rate is typically you can offer a adjustable as a 5/1, and what that means is it's fixed for 5 years, and then after the 5th year it adjusts once a year, and there's caps on these, so it's a maximum of how much it can be raised in any 1 year, and there's a maximum that it can be raised on a lifetime basis, and that's on a case-by-case basis depending on the lender and depending on exactly what you're doing. There's also a 7/1 arm, and then there's a 10/1 arm. There's a lot of different arms, but these are the most popular arms. And I'm going to get into a couple of other arms in just a few minutes. An adjustable rate mortgage or an ARM is a loan in which the interest rate may change periodically, usually based on a predetermined index. The ARM loan may be included in an initial fixed rate period that is typically 5 to 10 years. The interest rate then may change each year thereafter once the initial fixed rate period ends. So on the 5/1, it's 5 years, 7/1, 7 years, 10/1, 10 years. So after that initial period, then it's going to adjust up or down, but most people are going to think it's going to adjust up. But there are cases in a lot of markets where that rate will go down. For example, on a 5/1 ARM with a 30-year term, your interest rate would be fixed for the first 5 years, then it could fluctuate up and down each of the subsequent years for the next 25 years. Does that make sense to everybody? Any questions on that? All right. You can also buy down into an adjustable rate mortgage. And the two adjustable rate mortgages that I recommend when you do a buy down is the 7/6 or the 10/6. And what this means is that the rate, again, is fixed for the first 7 years, and then it starts adjusting every 6 months after the 7 years or the 10 years. The advantage to this is that you qualify at the fully indexed rate. And what that means is, and I don't want to get into too much, I don't want to get into the weeds here, or get into too much detail, but there's a margin that's determined by the lender, and then there's an index, and the index is the cost of funds rate, which is something you can look up on Google, cost of funds, and you can see what that index is. And you add the index and the margin together, and you come up with the rate that they'll qualify at. So those two arms are the only arms that you qualify at that fully indexed rate. The rest of the arms, you're going to qualify at the note rate +2, which doesn't really accomplish anything. But those two arms, you're going to adjust, you're going to qualify at the fully indexed rate. I kind of discussed this already. This is the index is the cost of funds index, and the margin is set by the lender, typically determined by what the credit quality of the borrower is and the specific adjustable rate mortgage product. Any questions on that?
Yeah, so if you do a 7/6 or a 10/6, okay, and then year 4 rates get really great and you want to refi into a 30-year fixed rate, what are the costs?
So what I typically, and this is something, that's a great question, Craig. This is something that I explain to the borrower and the realtor. So I'm going to talk about this strictly as the 7/6. So I explain that this is a temporary loan. In the next 7 years, one of two things needs to happen. Either rates drop and I refinance you into 30-year fixed, or at the end of the 7 years, you need to sell your home. So one or the other, because the uncertainty of that rate adjusting every 6 months is going to be pretty much too much for most people to deal with. And not knowing what your rate is going to be every 6 months changing. So the cost of a refinance, depending on if you go back to the lender that did the first loan for you, our company particularly is going to do a very good deal for you. We'll do the least amount of closing costs that we can possibly do.
Okay.
But there is going to be some cost involved. You're going to have title. You're going to need to do an appraisal. You're going to have, you're going to have a credit report. You're going to have all those costs. But typically our company is going to be, we're going to give you a great deal on refinancing that rate when rates drop.
Right.
And I feel as though rates will drop sometime in the next 7 years.
Okay. And then what is the upfront cost on this, like a 7.6?
These are typically, I mean, if you want to buy it down, you're going to use, I mean, this is a normal loan. You're going to have, depending on where rates are at and where we want to buy it down, it's all going to be on kind of a case by case basis. But you can use seller concessions to pay for all of this.
Okay, well, yeah, so let's say we use seller concessions, right? On FHA, you can go up to 6%, 4% on a VA. What is like on a 2-1, it's what, 1% of the loan amount or whatever, or the purchase price, 1% of that for the 2 years, right? So that'd be, on a $300,000 house, that'd be $6,000. So what is it like on a 7.6? What's the,
So it's typically going to be about the same thing. Typically, and it's not that case right now, because with the market being uncertainty, rates are not being affected very well on the adjustable rates currently. Now that will change over probably the next 3 to 6 months. There'll be what's happening is a lot of the big institutions are not buying. They're not buying adjustable rate mortgages right now. So this is not as big an option as it's going to be in the coming months. So unfortunately, the rates and the market changes on a daily and sometimes multiple times per day. So what I try to do is to come up with as many options, and then I'll recommend the options that I think are the best for the borrower at that particular time.
okay. I mean, can you, like, I get that, it's probably expensive or whatever. I'm just trying to get, like, if I'm going to pitch this to a client going, hey, here's another way to, instead of a 2-1 buy down, where that's only, helping you for a year or two, this is maybe more attractive for the right buyer. But what's it going to cost them? What's it going to cost the seller if we have them pay for it? I'm kind of getting like a basic cost, so I can factor that into our offer or whatever. That's what I'm kind of looking at. Like the question I guess I'm asking is how much is on this.
So typically that's a good rule of thumb, is 1% is going to buy the interest rate down 1/4 point. Now, typically the ARMs are quite a bit lower than a fixed rate mortgage. Right now, unfortunately, they're not. They're about the same. They're slightly lower each and every day, but they're not considerably lower right now. But they will be in the coming months.
Okay. All right. Appreciate it.
Okay.
So 1%, Jim, typically is about 1/4 point.
Yes.
Okay. Okay.
Any other questions?
I like the 7.6 idea and the 10.6 idea for the right person.
Yes. Yes. Because they're gonna qualify at less of a rate, which is going to put them in a better position. They're going to qualify for more house.
Yeah, if somebody's moving in and they know they're just gonna be here for, 4 or 5 years with a job, and then they know they're gonna be transferring out. People like that, I could see that being a really good option for. I just looked up how long the average person stays in their house. I thought it used to be about 5 years. It actually said in 21, it was 8 years. So it's a little bit longer than the kind of that 7-year situation.
Gone up a little bit. But
gone
that's the
up a
thing.
little
I think
bit.
a lot of people, like even that, the 7-6 arm for some people, like if they're going to move within
Yeah, they
7
know
years,
they're
they,
moving.
first time home buyer, they're thinking by then we'll probably move on to the next house and whatever. Like there's just some options there, I think. And I do think rates are going to, I mean, I think who knows where they're going here. I think they're going to probably continue to go up here for a while. I have a feeling. I don't know. Jim, you might have a better feeling.
Yeah, I kind of think the same thing, but I think
But we're going
sometime
to see a
in,
drop.
yeah, sometime in late spring of 23, I think rates are going to start coming down. I don't think they're going to go down as far as they went this last time,
No.
but
Mhm.
I think we will. I think in the next year to 18 months, we're going to get back into the fives. Is my feeling anyway. Everything that I've read and everything that I've seen from economists and everything else, that's what I'm thinking.
What's the
Everybody's gonna have-
highest you kind of that you're, amongst the loan officers and all and everything, what are the highest that y'all are kind of speculating based on all y'all's information that they're going to get up to over the next, 6 months or so?
I feel as though we're probably going to get into the mid eights. But I don't think they're going to go any higher than that.
I saw a post from a lender earlier in the week, and he was like, "Mark my words," or last week, they're going to get 10 to 12. I was like, "Whoa!" He's the only one I've ever seen that said that, and I thought I'm not going to get on that in I was on Facebook. And I was like, I'm not starting that conversation through Facebook. But I was wondering where he heard that. Like he's been around a while, and I'm like, wow, that's the first person I've heard in that world that has said that. But if that is kind of what what the combo was, it's like that's a good time to start having conversations with people. Like, at this point, 7's good, if it really is going to go 10 or 12, right? Or some of these other options you're talking about, like, don't wait, because if they go to 10 or 12, it's going to affect your buying power even more.
I'm probably a little bit older than everybody on this call, so I remember in the late 80s when the rates got to 18.
Yeah.
And people were still buying homes.
Yeah.
And I don't think it'll ever get to that point again, but and I don't really think they're going to get past 8.5, but they could, who knows? None of us have a crystal ball to know, but I feel as though.
Go ahead.
Good, Kathy. I'm sorry.
I was going to say, then what happens is you guys just come up with different programs like we're talking about today.
Yes.
We adjust through, just like we did, back in 2008, 9, 10, during that time. We adjust through, new programs come out. We learn about these, new options to talk to our clients about, like, one way or another, people are still moving, and one way or another, we're going to, just be able to help guide them, with some of these other programs, things like that.
Absolutely. That's definitely the way to look at it, Kathy.
Mhm.
It's not doomsday.
Yeah.
There's always options.
For sure. Trish, you have a question? You want to unmute yourself?
Yes. Actually, I have a comment on the arms. If you buy down or you get an arm now for 7 years and then it adjusts, the actual break-even point is beyond that 7 years. And I did that math once, and I can't say how to do it, but probably Jim would know how to calculate if today you buy a 7/6 arm or a whatever arm, right? And what happens, in year 6 or the first year after, the second year after. And I discovered this because I used an arm, and it was a 7-year arm, and the break even would be like at almost 10 years, the money I saved. So that's just another way to look at it, especially if you have a buyer who's very conservative and really worried, I might get a relocation in 5 years, or it might be 10 years, and how to look at that in another way to say, hey, at least this is a break-even point versus going with the higher fixed rate or not buying at all. I just wanted to throw that in there.
Yeah, on a 7-year arm, you're probably looking at I mean, if the borrower is paying for it all himself and he's buying the rate down on a 7.6 arm, you're probably at somewhere between 9 and 10 years to break even. But the arm could actually go down also, depending on what's going on in the market. I don't know if you experienced that after your arm adjusted. Okay.
Well, I actually moved, but yeah, it went
Okay.
down.
Okay. And another thing that's starting to surface are qualifying. There's mortgages out there that are assumable now. That VA loans have always been assumable, and now there's FHA loans now that they're bringing back some of the assumability on those as well. So that's another option on somebody that's selling a home. I know that it isn't particularly, we don't like that on the real estate side, but there is an opportunity for a client to have their loan assumable.
I think one thing, guys, is again, talking with renters and this kind of stuff. A couple of things I've seen here lately, again, as people pull back because, well, the rates are too, I'm going to wait till which again, I think they will drop over time. But I just read this yesterday in September. This is from Lawrence Yoon, chief economist for NAR. Rents rose by 7.2% in the month of September. It's the highest pace in 40 years. And I saw this too last week, that 72% of landlords across the country, this is a survey that was taken, 72% of landlords plan on raising their rents over the next 12 months. So that is a price that's not fixed. And obviously you can fix in your price when you buy a house. I mean, so to have these kind of conversations with your prospects, who are renting and just at 100% interest, essentially, that's where they're at. It's a conversation to have with some of these people. Exactly. Kathy just put that in there. It's something to think about with this as you're talking to prospects and talking to clients and different people that those are some stats that are like, wow, like that's just something that can be talked about. There's still ways to get in. Joe, you had a question? You have your hand raised?
Yeah, so my question is on the arms, is there any sort of down payment requirements on those?
There isn't any down payment requirements. There is credit requirements depending on the lender.
Okay.
There's certain lenders you have to have sometimes a 720 FICO score and higher.
Okay.
Depending on the lender and depending on the program.
Okay. Yeah, I didn't know if there was going to be a minimum of 3% or 5 or so.
No, you can do an FHA arm at 3%,
Oh, perfect. Okay.
3.5%. And you can do an arm on a VA at 0% down.
Oh, perfect. Thank you.
There is some credit requirements though, depending on the lender.
Perfect. Thank you.
Sure.
Good question. Go ahead, Jim. Hit this slide and then we'll kind of open things up here a little bit. Okay.
I know all of this sounds pretty complicated, and as a loan officer, I go through and figure out all the different options and explain those options to the borrower and the realtor. With interest rates on the rise, these options can help borrowers afford the house that they want. How I explain the adjustable rate, as I already told you, one of the two things needs to happen in the next 7 years. Either interest rates go down and I refinance them into a 30-year fixed rate mortgage, or they need to sell the home. And statistics show that the average person moves or refinances about every 5.5 years. And I know it's gone up on when they move out of the house to probably 7.5 to 8.5 years.
Cool. It's good. One of the things that I just want to hit here real quick, I'm going to share my screen for just a second.
Let me share mine for just one more second.
Yeah, go ahead. Go ahead, Jim. You're good.
This is how to contact me. If you have any questions about anything we went over, or you'd like specific questions on your particular case, my name is Jim Sherman. My email address, jim.sherman@bentoncap.com. My phone number is 719-499-5588.
Okay, so phone number again, guys, 719-499-5588. And you can reach out to Jim. Jim, where, and again, not, and I appreciate you getting on here. I mean, we've done a lot of work with you guys with Benton Capital. They're awesome here in town. But you guys you're licensed like all over the country, right? As far as what you guys can do.
Yeah, we just made a change that hasn't even been announced yet. So you guys know stuff that nobody else in the country knows, but we're now licensed in all 50 states.
Okay. So, and again, you've got your particular lenders that you all use and stuff, which is great, but this is worth having a conversation maybe with them too, to find out what some of the different things that they're doing, be the expert, for your clients. I mean, cause a lot of them just they don't know how any of this stuff works. Somebody bought a house 5 years ago and they're looking to do something. I mean, again, and all this crazy market we've been through. I mean, buydowns haven't been around for a long time, and they're coming back because of what we're going through, So, real quick, Jim, can you repeat your email for everybody?
Can you see it on the screen?
No, you're not
wait.
shared right now. I'm sorry.
Let me share my screen. Sorry.
Yeah, go ahead. So people could write this down just so we get it on the video as well. There you go. You guys want to take a picture of that? Now we can see you, Jim. I can
Yes.
see you. Your camera's working.
And it's not live for some reason.
Oh, I see. Okay.
Well,
So-
there it is. Live now.
There you go. So jim.sherman@bentoncap.com. There's his phone number. Once again, so you could, write that down. And are you okay if these guys, give you calls? You might get bombarded with some calls with questions and stuff after we're done.
No worries at all. If
Yeah.
I don't answer right away, leave me a voicemail. I will get back to you.
Yeah. Known Jim for a long time.
Maybe late this evening, but I'll get back to you.
Yeah. So one of the things that I just want to share real quick, guys, again, talking about some of the stuff with the rates. Let me just show you one thing. And I've shown this before, I think, but just so you can see this here. If you look back, here's the last, going clear back, here's 1971 down here at the bottom of this chart. Here's a recession, 1980, 1982, we hit another one coming out of 9/11. You can see all these different recessions, right? Well, again, over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact, as it takes some time to turn things around, even when the recession is technically over. So if you look at this, I mean, again, sometimes the biggest rise in rates also led to the biggest fall in rates. The rates typically in this time, they go up, but then eventually, okay, we got to get the economy going. They're trying to jumpstart things. The rates start coming down, and eventually they come down. Now, how far will they come down and when will that happen and all that kind of stuff? I mean, none of us know. None of us has the crystal ball on that. But here's typically what happens. Again, if we go back through the past 5, even 6 recessions, here's what happens. Will that happen again? Chances are, yeah. When? Nobody knows. There's all kinds of factors in there, whatever. It's a crazy time, obviously. But, and we've seen major shifts fast. But that's typically what will happen, as time goes on. So just things to understand and be aware of. It's not doom and gloom and the sky is falling. There's still ways to get this done, but the clients don't understand this stuff and they don't know that stuff. So that's where we have to come in as the experts in this industry, and educate the clients. There's still ways for renters to get a good rate and get the payment that they need on the house that they want. They might have to come down in price a little bit from what they were looking for before, but we're also going to see adjustments in prices. We're starting to see that. I think the places in the country where we've seen the highest, spike in prices, we're also going to see some of the drops in prices. But if you look at it also, the last thing I saw, I shared this with the people in Montana last week when I was up there, right now the forecast for this next year going across from NAR to Fannie Mae, Freddie Mac, everybody, it's kind of all over the board, but we're seeing really a pretty flat 2023 for the most part. That's the average. Some predict prices are going to come up just a touch. Some are going to say they're going to drop. The average on all of it is like 0.2%. So really a flat market is kind of what people are forecasting for 2023. If you look at the recession, again, I've got stats on this and I could show you this. If you look back in the big one that we all think about, 2008, it was 5 years of price drops on homes. And then we come out of that in 2013 and there was like a 7 and 8% increase in prices. The average across the board for price increase, if you go back over the last 30 years, is about 4% a year. Here's typically what it is on an annual basis, about 4% in price increase. You know, we saw these big spikes in 2013, 2014. We obviously saw big spikes the last 3 years that were unsustainable. You know, and we all knew at some point that can't keep going the way it's going. You know, so we're seeing a lot of adjustments going on right now. It's all hitting in big ways fast, but there's ways to navigate through this. We're going to see a lot of agents, I think, you know, just walk away and get out of the market. You know, and it doesn't have to be that way for all of us here who are serious about doing this business. You know, it's not a time to panic. It's a time to grow and to learn and to educate yourself and educate your clients. And, you know, now's a time, honestly, where you can gain a lot of market share. That's what happens. My biggest years in my 20 years, my biggest years were 2010, 2011. It was a pain in the neck because we were doing short sales and all kinds of stuff, but they were huge years for us. You know, and so there's a lot of people that will come out of this shining in big ways, and it'll carry your business for the rest of your career. The reputation that you get over these next 12, 18, 24 months as we go through this, you know, so some things to think about. Sean, could you unmute yourself? Do you mind, Sean Corbett?
Sure. What you got?
Real quick, just any thoughts? I know you popped in late here, whatever, to this. I appreciate being on here. It's always good to see you. I mean, you know, broker owner down there, been with EXP here for a while, been in the business a while, doing a lot of stuff. Are you guys, what are you guys seeing right now as far as, are you doing some stuff with buydowns with your sellers, buyers? Have you guys got into that yet at this point?
I've used some different strategies like that. One of them is I've got a builder, right? So, and he's a small builder. And I know most of you, if you've worked with some of the builders in the last few months, they're offering some really competitive options, right? Low interest rates, because like a DR Horton, for example, can hold a lot of money, and then they can turn around and put it back on their own purchases for clients and offer, you know, 5 and 6% interest rates. You know, so they've been able to do that. Well, for us, my builder I'm working with, instead of dropping price, we've offered some incentives for them to work through us through buyer buy down options, right? He's got a partner lender that's offering a really significant option for any buyers that are looking at our product, because they're looking at, you know, the semi-custom builder options, and they can offer a lot more things than we can. So I have used that out there, and you know, I flipped a house out in Tacoma, Washington. I finished about 60 days ago, and we put in there that we were going to give away like $25,000 in concessions or buyer buy down to help get, you know, a more reasonable rate. And it got on the hook a couple of offers pretty quick. Yeah. I can't say that works all the time. You know, the Tacoma market is certainly a lot different than, you know, Dallas Fort Worth that I have here. But, you know, it's something that we did try to utilize to try to offset the high interest rates. You know, it's funny, Jim, I know Jim pretty well. He and I know each other, doing some other things together. It's kind of fun to have him on here. You know, the one thing I thought about was, and I haven't dug much into it, but I heard him talk about VAs are always assumable. And now they're looking at FHA becoming assumable again. Are there options, you know, in the last 7-8 years of closings where they were closing in these low interest rates? Is that a fair assumption that generally all loans are not assumable outside of, like you said, the VA? Is that a pretty fair assessment?
Yeah, conforming loans have never been assumable, but VA has always been assumable. Now, the downside of assuming a VA loan is the veteran now loses his eligibility to an extent. Now, there are some things that it is possible now for a veteran to own 2 homes, to use his VA twice. I didn't know that until I got back into the business again 2.5 years ago. So if he hasn't used all of his eligibility to buy the first home, he can purchase another home with a VA loan. So there's a lot of unforeseen rules and that are actually good for us that weren't used over the past few years because rates were so low. Nobody even thought about assuming a loan. One of the interesting things is assuming a loan, you're going to have to come up with a pretty good sized down payment to assume the loan, typically with the price structure or the prices that are out there, but it is an option to do. There's also doing piggyback first and seconds. So you could assume a first and then do a second to make up some of the difference.
And Sean, going back to what you were talking about earlier, like the $25,000 in concessions and stuff. Before you got on here, one of the things I first mentioned when we got on here was just how buyers aren't concerned so much about the price of the house. They want to know what's their monthly payment. Can they afford the monthly payment?
Yeah, that's what
Sellers are concerned about the price.
Yeah.
Whatever they want, the highest price they can get. The buyers want the lowest payment, and that's the way this buy down. It's a creative way to do
Jeff,
it.
that never really changed, right? I mean, if you
Yeah.
know buyers and their strategies, like as dumb as it is, like even buying a car, right? They never talk about the price. All they ever talk about is the monthly payment. It's because all of us are always concerned about what I can afford is based on what I can afford monthly. Like we don't think about, most of anything else. And lenders have debt to income and other specifically monthly targeted options, but that's still the same today. I mean, if I were buying at 3%, I still have to consider what I can afford per month. It's the same as a buyer buying at 6 or 7%. It doesn't change. If you guys can think in those terms, take the interest rate out and focus on that, and you can work backwards to determine, where's your buyer need to be looking. I mean, that's always the case. And Jim, someone was asking about VAs. There are requirements or restrictions on how far apart the house is to do a second VA. And
Yes.
I know there's like other specific, things that you have to follow, because there are VA people that have investment properties using VA loans because of meeting those certain type of, requirements and things like that. I've seen that.
Yeah, I don't know if everybody knows this, but as a veteran, you can buy a duplex as long as you occupy one side of it, also a triplex and up to a fourplex. So somebody can buy a fourplex. Now, if they have any rental experience at all, they can actually use the income from the other 3 units of a fourplex to qualify. But they have to have rental experience for a couple of years in order to do that. Great
Craig has a question here, Jim.
Okay.
Is there a minimum refi time frame, or what's the soonest you can refi? I've heard 6 months for a minimum.
Yeah, it's between 6 and 8 months, depending on the lender.
You can refi rate and lock right away, but you cash out refi, you got to wait 6 months.
Well, there is the lender that did the loan, depending on how the loan was structured. If the loan is paid off in a certain period of time, and you can't control this at certain times, but typically the lender that you went through, if you go back through the same lender, they're going to want a 6-month period before they can refinance. In some instances, it's 7 months, and some it's 8. Otherwise, they look at it as churning the loan just to make money. That's an insurance term also, on rewriting an insurance policy also. But you can't, but it's something that can't be completely controlled. I mean, you could go to another lender and you could refinance your loan. Some lenders are going to let you do it, some won't.
Yeah, they got to hold the loan long enough to make the money. I mean, that's why internally they wouldn't do it. But yes, you could go
Right.
a separate. I'll tell you another fun topic, Jeff, just for fun, is owner finance. I know that takes us a whole different direction and a whole lot of different liability and restrictions. But I do quite a bit of that as an alternative, because owner finance can be 9.9, and that looks really good to a buyer that doesn't want to see their debt to income or anything hit, and then they are able to finance directly with the owner as a kind of a third option. And there are scenarios where that's really attractive, especially for cash flow on financing properties, or for just a buyer that has zero chance of ever qualifying, for whatever their reason is. That'd be a fun topic. I don't know if people are excited about that, but I've created a lot of really creative solutions for that. So anyway.
No, that's a great topic, Sean. I do owner financing myself, and it's become a little bit easier now than it was before. A lot more owners are open to doing that.
I love it. And it's safe. I mean, you do an RMLO, they set up the docs, everyone's protected, and everyone knows what the risk is, and you just don't have to go through, you don't even have to get title insurance. Like, it's a whole different animal.
Yes.
Yeah, it's a fun topic. So if we ever want to talk about that, I can probably share.
It'd be good. We could talk about that at some point. I haven't thought about that forever.
I know. a lot of things are coming back into play that we didn't think about for a long
Yeah,
time.
definitely. Jason, do you have a question?
More a comment. I just had an email flash across the bottom of my screen, and it says, surge in mortgage rates, possible surge by 2023, 11.6%. I just thought that was kind of timely considering what we're talking about right now.
Yeah.
That's what I told you. My lender put that out there last week, or one of them. So interesting. We'll just wait and see. But like we said, I mean, programs will be adjusted. We'll figure ways to work through it. But, as the professionals, we've got to be the one to, to not play into the doom and gloom news, because we know that's what the news is always going to project.
But I thought the news was always correct 100% of the time.
Always right. And always positive.
Yeah. No, for sure. It's a great point. I mean, there will always be programs and stuff. I just think, the housing, I mean, real estate it's just such a hub of the economy. You take out real estate, you slow down real estate. And I mean, Home Depot slows down, Lowe's slows down, all the contractors, all the carpet companies, the paint companies. I mean, it's just the domino effect of slowing down real estate. And so it is one of the things that they, at some point, whatever, they will do things to try and jumpstart it and get things going again, because they have to. It's just everything flows out of this.
Well, and the truth of the matter is, what we kind of touched on already, is people have to have a place to live. So
Yeah.
what's the alternative to rent? And rents are going up as well, right?
Yeah.
Rents are already ridiculous.
Yeah.
And so, at the end of the day, do you want to be building wealth? And I don't remember what that is, but, the average American who owns a home, they have, not only do they have more wealth, but their kids are much more well-adjusted, right? There's so much other value that comes along with that. And that's what we need to be, the voice of all of those things. I mean, again, what's the option? Renting and paying $2,500, $3,000 for rent for a house for your family versus, a home that you can start building some equity in and, have something to leave to the kids, at the end of your, life.
Yeah, for sure. Well, good stuff, guys. We're going to wrap it up. So, Jim, if you could share on Google Drive, just share that PowerPoint with me, and then I will upload it into the Freedom Team group in Workplace, so you guys can all have access to the slides. For those of you not with EXP, I do have track of all the emails here, so I will email out the slides to you. We'll get those to you. The recording of this will be uploaded into the Freedom Team group within the next, 30 to 45 minutes. Okay. And then I can also email the recording out to all of you who are not part of EXP. We'll get that out to you as well. If you got on here late, I would go back and watch it. Some great stuff put out there. Some great things to think about, look at. So, Jim, thank you so much. Totally appreciate it.
Thank you very much for having me. Thank you, guys.
Sure. You guys can reach out to Jim over there at Benton Capital, again, licensed in all 50 states, but also you could take some of this to your lenders and start having some conversations and see what's available where you are with what you can do. There's lots of ways to make this work, though. It's definitely not doom and gloom time. It's just time to get creative and educate your clients, whatever. And we get through this and you shine getting through it is what happens. So you're the hero when all of a sudden that renter who, thought they were done and just had to rent for the next couple of years, and now they can get into a home, whatever. And now they're thrilled and they're singing your praises and sending you more people. That's what happens. So anyway, last comment real quick, just a reminder next week, okay? 10:30 Eastern, 7:30 Pacific, and we'll be on here for really 3 hours with this Realtor Wealth Summit. 6 different speakers, several icon agents talking. It's going to be awesome. All kinds of training, all kinds of value, and then an EXP presentation immediately following that for those of you who want to stick around or invite guests to come into that. We'll have all the details out in the Freedom Team Workplace group today and throughout the week here. So any last comments, Kathy, before we wrap it up?
Nope.
Thank you so much, Jim.
Well,
Thank you
welcome.
again.
Thanks,
Thank you,
Jim.
everybody. Have a great week, okay? Call us if you need us. We're here for you, okay? Bye-bye.
Bye, y'all.
Bye.